What's up, guys? It's Rob here, and today we need to talk about Jerome Powell and something that he just said in his live Fed meeting. It's actually still live right now, I believe, and we're going to play a small clip from it, as well as discuss some of the things going on in the economy that could be causing some additional rate hikes and potentially some damage to the stock market. So we'll start off very briefly just by looking at the S&P and going over what happened in it during the Fed meeting. So at 10 o'clock, Jerome Powell started talking, or at least his testimony began, and some others began, leading the meeting off. And the S&P actually rose a little bit as that happened. However, over the course of the meeting, some things Jerome Powell potentially said weren't too popular with investors, and we moved down just a little bit. But we didn't see anything crazy in the S&P over the course of the meeting. And one thing that I did want to cover before we actually go to the live Jerome Powell meeting interview is basically just what Goldman Sachs has predicted about the Fed raising rates a couple of times this year, actually more than what we were expecting, because previously the Fed has said that they will be raising rates probably 3 times during the course of 2022. Now, this news actually came out on January 10th, so yesterday, when Goldman Sachs predicted this, and it actually lines up pretty well with what Jerome Powell says. We're going to listen to that clip in just a second, but essentially, Goldman Sachs is predicting that the Fed will hike rates 4 times this year, more than previously expected. Previously, once again, the Fed predicted 3 rate hikes this year, and they didn't explicitly say in the interview that there would be 4 rate hikes, but they did allude to the fact that there might be. So here's Jerome Powell. We're going to listen to him for about a minute. He says some fairly interesting things about inflation and the severity of it. So let's take a listen to this.
I will say, though, if we see inflation persisting at high levels longer than expected, then we will, if we have to raise interest rates more over time, we will. We will use our tools to get inflation back, and the main reason is this. That to get the kind of very strong labor market we want with high participation, it's going to take a long expansion. We can see that participation is moving only very slowly, and to get a long expansion, we're going to need price stability. Right. And so, in a way, high inflation is a severe threat to the achievement of maximum employment and to achieving a long expansion that can give us that.
So there you go. He said it himself. Inflation is a severe threat to achieving some of the economic goals that we've been hoping to reach over the past couple of years. Obviously, we want low unemployment. We want to be going through a growth phase in the economy perpetually. That's obvious. And once again, inflation, as the Fed was saying in the past, it may not have been that big of a deal. Now, Jerome Powell is starting to change his tune a little bit. He's starting to admit potentially that inflation could be a little bit worse than what we were initially expecting. Once again, he called it a severe threat in this, and he also, at the beginning of that clip, said that they would be raising rates more if it was necessary to keep inflation under control. So obviously the Fed wants everyone to believe that they have things under control, that they can affect inflation in a beneficial way for the economy. Potentially they can. Hopefully they can. We'll see if that happens. We are going to look at the CPI numbers in just a second, but while we're still on YouTube, I did want to briefly show you guys the channel analytics just right here. We have about 9,600 subscribers to the channel, and we're trying to get this to 10,000, so we're only about 400 away. So feel free, to subscribe if you haven't already. If you want more of this kind of news, then feel free to subscribe to the channel. We cover this kind of stuff, inflation stuff, all the time, and in fact, tomorrow we're going to be doing a live stream discussing the CPI numbers that are actually coming out at 8:30 on January 12th. So tomorrow morning, the CPI numbers are coming out at 8:30. We're probably going to be covering this live at 9. That's the plan, at least. And we are forecast to have fairly high inflation, right? We're forecast to have a 0.5% increase in prices for the month of December. So already, the Fed might be right. They might have to raise interest rates 4 times like Goldman Sachs was predicting to get this inflation under control, because here you can see the chart of inflation and CPI readings, basically. So you can see that over the past couple of months, we have had fairly high CPI readings. For what we've seen over the past 10 or even 20 years, if you look back, inflation has not really been all that high since way back when. And even back in the 90s, we didn't see inflation this high. What we've seen recently, we've seen readings of a 0.9% increase in multiple months over the past year. So it's somewhat scary stuff. Obviously, inflation is a somewhat sizable threat. We've also had relatively low interest rates for a long period of time. Potentially that's helping to contribute to this, and that might be why the Fed is now considering doing these rate hikes. They're obviously trying to slow down this inflation, because what you can see if you look all the way back to the 70s and the 80s is that inflation really can get out of hand somewhat quickly, right? You can sometimes see a bit of a spike up in inflation, and maybe it dissipates for a little bit, but if you don't really get it under control, you can see somewhat severe inflation. I know that during this period of time, a lot of people were suffering due to the massive inflation that was being seen in the 70s and 80s. It was a relatively difficult time, and the Fed actually had to raise rates quite a bit. Interest rates were really high towards the end of this inflationary period. So maybe, hopefully we don't see something like that again, but obviously we did print a lot of money. Recently in 2020 and 2021, a lot of money has been added to the circulation. So hopefully we don't see something like that, because we probably couldn't handle it nearly as well nowadays than we could way back then because of a couple of reasons. One, debts have been increasing. And if you look at this scary story that came out today, it actually discusses debts for American families. So amid rising prices, right? So amid inflation, American families fall deeper into debt. And the scary statistic that we've got is that including, all forms of families' debts, if you look at their credit cards, their car loans, their mortgages, their personal lines of credit and whatnot, the average family now owes $155,000 in debt. So that is actually an insanely high number. A ton of debt has been taken out in the United States. Families are massively in debt. Now, granted, that includes mortgages as well. So it's not to say that there are no assets backing up any of this debt, right? It includes car loans. It's not just pure debt with no collateral behind it. But it is scary to see that there is this much debt out there and that the Fed is talking about rate hikes, because currently interest rates are incredibly low. And despite having all of this debt, it's not too big of a burden on most families because the interest rates are so low. You're essentially just paying off principal most of the time and not that much interest. But if the Fed ends up raising rates a bunch, particularly if they raise them more than's expected, then we could actually see quite a bit of pain for families, because even a 1% rate hike on this average debt would be about $1,500 a year that families have to come up with in interest. And if we saw something like a 5% rate hike, it could get pretty out of hand pretty quickly if we did end up seeing very high interest payments on all this debt. And that's just families' debt, right? If you actually look at the U.S. national debt, I mean, the government could be paying a lot of interest as well. Currently, the whole nation as a whole has about $29,714,333,000,000 worth of debt, and you can see that this number goes up by tens of thousands of dollars every second. So the national debt is absolutely massive. It breaks down to about $89,000 per person, so almost $90,000 per person. We're getting scarily close to $30 trillion worth of debt, and there is still bills in the works like the Build Back Better bill that want to spend a whole lot of money coming down the pipeline, and potentially that won't get passed, but we'll see. But the long story short is essentially that we may want to watch out for the markets. I mean, obviously they're moving up right now. It looks like maybe Powell just said something live that the markets seem to like, but we will want to watch out for this inflation situation. Once again, at 8:30 tomorrow, the CPI is coming out, so make sure to join the live stream tomorrow at 9. Subscribe to the channel if you haven't already for that. But we will be watching inflation. It's going to be something that's relatively important to watch for over the course of 2022. It's probably going to have a big impact on the economy and the stock market. So definitely keep an eye on inflation, especially with the amount of debt out there. It could be somewhat bad to see really high inflation and really high interest payments on a lot of the debt that people have. That could really be a real dampener for the economy. So keep an eye on it. And other than that, guys, obviously keep in mind none of this is financial advice. I'm not recommending anyone do anything with their money, but just keep that in mind. And don't forget to subscribe to the channel and like the video, and join us for the live stream at 9 tomorrow. So other than that, guys, have a great day. I'll see you in the next one. Bye.